I want to refer to your most recent piece of research, and I was struck by a chart in there. You've coined a new shape for the recovery. We've heard lots of them, of course, right? W, V. This is a square root. It looks kind of like the Nike swoosh, but it's a little bit different. What I zeroed in on here, Henry, and what I want to draw our viewers' attention to is the time frame. 10 quarters for the economy to return to its pre-pandemic level, not until mid-2022. What should 2.5 years of lost output mean to an investor?
Well, a couple of things. One is we do like the square root shape. I don't know. My dad was a headmaster and a math teacher, so maybe that's where we got the analogy. But I think what we're trying to say is that there's going to be a huge explosion of growth, which is what we've seen over the summer. And now things are going to grow, but albeit in a slower rate of change. And you're already starting to see that in the data, and that makes sense to us. There's a lot of really good stuff going on. We have a huge Asia franchise, and we're seeing pretty strong growth out of that. You've seen some of that, the China data. Europe is actually their cases have come down and they're doing well. But ultimately, some of the benefits will start to run out from the government, or they'll come at a slower clip than what we've seen in the past. And also, we're going to have to face a slower unemployment or a tougher employment environment going into 2021. Our estimates, we're looking for about 9 million jobs being added this year. We've added about 2/3 of those in the U.S. already. So, that's a daunting task. I'd say that for investors, what we're trying to focus on as a fiduciary is where to deploy capital. And there's quite a bit of liquidity in the system right now. And as I think you highlighted, and you mentioned the piece we put out, look, we've tried to be very thematic in our investing from a top-down and a bottoms-up perspective and really create that marriage. And I think there's some very exciting themes that we've been investing behind for years that became on sale during the past month or two, and we've been able to take it, to lean in there. And I think there's still more upside. And what we're trying to focus on is kind of what's going to happen in 21, 22, and 23. That's most of our capital is long term, and that's what our investors want us to do.
Henry, is it possible to quantify the economic cost of the bungled response to the pandemic in some of the southern and western states?
Look, this disease, and we see this right now. When you could argue about the response in the United States, but even in Australia and Hong Kong and Japan and China, where there's been really, I'd say Asia's kind of led the way on this. We have seen cases reemerge. This is a wily disease, and until there's a vaccine, I think we all need to. The reality, we're probably going to be wearing masks, and that there'll be fits and starts. And so, one of the big migratory patterns we've been watching for years coming into the coronavirus was people migrating, down into the South, into Texas. And obviously some of that will come under pressure in the near term. But generally, given the demographics we see in the U.S. and our long-term focus, I think those trends will continue.
Henry, you take a lot into account in your analysis: employment levels, obviously, government stimulus, the savings rate, business closures. One thing I noticed is largely missing, and that is China. And of course, the latest developments today are the tit-for-tat consulate closures in Houston and Chengdu. Should we assume that America's escalating confrontation with China is something of a new normal?
Yeah, and I think, Erik, it goes back to, if you maybe rewind 2 or 3 times when we spoke before, I'd been going to China since 1995, and I told you that I thought there was a secular shift in the U.S. China relationship. Nothing's changed in my mind from that perspective. And, what we're seeing, I do think that is that continuation. Remember, you and I talked about trade as a percentage of GDP actually peaking in 2008. So the trade wars are new, but the data has actually been bearing that out for almost a decade, over a decade. And then what we're seeing now, that's kind of a new chapter, and what I think you and I have kind of fleshed out for folks over the past couple of sessions, is that it's expanding in terms of strategic priorities beyond technology into areas like healthcare. That is new relative to the coronavirus. And I think it emphasizes what we're trying to do at KKR, which is we're trying to get 3 things right. One is we're trying to get our themes right. Where are we going to see GDP plus growth, and really understand that at a sector level, and and then do that globally. Number two is find companies where we can create operational improvement. And then number three, which I think is incredibly important during this period, is create durable capital structures that allow you to weather uncertainties. And that obviously the coronavirus is the cherry on top in terms of uncertainties. But that's what it's going to take in this cycle. There's certainly a lot of liquidity in that, but you can't just bet on liquidity. You've got to be thoughtful. And I think we learned some lessons in 2007 and 2008. And part of my job has been to help the firm focus on that, and there are a lot of others doing that. And I think that the team, and this is in the piece, we've leaned in around some deployment opportunities to try to do the best job for our LPs, and I think that's been the right thing to do. But keeping in mind that the huge human element of this, it affects our employees, our LPs, and certain potentially most importantly our portfolio companies, the people that are working to try to create value for our LPs.
Henry, where do you expect to see the U.S. China situation deteriorate further? What are the next pressure points? And how will that deterioration affect what KKR does in China and in Asia more broadly?
Look, I think in Asia, we're going to continue to invest. You mentioned my role on the balance. We're trying to grow our allocation in Asia, real estate and infrastructure. I think the U.S. China relationships will create more volatility. And that will create an opportunity for us to lean in. In a bigger picture, you could end up with something that looks more like a regional economy with Asia and then Europe. Look at what just happened with the reunification fund in Europe. That would have been unthinkable, radically different than what happened in 2000 and 2012. And then in the U.S., you could ultimately have the Americas with Canada, the U.S., and Mexico. But that will take some time. I think the near term as we head into the election is we'll see an increase, and I think certainly more out of Beijing and more out of China. And that's why, you and I about this before, we remain in the camp that rates are going to stay low. And that drives our thinking around infrastructure, around asset-based finance, and around real estate credit, where we're continuing to grow our franchises. I think what's really important right now and investors aren't focusing on is that you're seeing nominal yields actually come down. The 10-year is under 50 basis points, but inflation expectations are going up. And so real yields are diving downward. And that's why you're seeing gold go up and silver go up. And, in our view, that's what liquid public investors may invest behind, but it really is, it's a confirmation of our strategy that we've really built out globally in infrastructure around real estate and some of our asset-based finance. And those are going to be important areas for investors to pivot to on the private side during what we think will be a lower return environment, given all the stimulus that's been applied to the system and given the big bounce off the bottom.
Henry, you took a close look at how KKR invested after the global financial crisis. What mistakes do you think the firm made then, and how is it course correcting now?
Yeah, I think there are three things. I oversee our risk function, and there are three things I focus on for the firm as well. Number one is pace of deployment. You want to be leaning in during uncertainty and probably pulling back when things feel a little bit jubilant. And the second is not having too much leverage. Ultimately, private equity and other types of private investments, you have an embedded option in what you do, and if you reduce that by having too much leverage in the structure, it won't work. And then the third, Erik, that I think is the most important, what we really focused on, is not making implicit red-black bets in the portfolio, like not owning things that you might own an energy company, then you own a retailer in Texas, and then you own something else that's tied into energy, and all of a sudden you have a much more of a concentrated bet. So I think what you see in our portfolios today relative to the last cycle is a lot more diversification. We've used our capital markets business to help us, syndicate some of our equity to bring in partners too. And so, I think we've been able to be aggressive, but also work with a lot of the leading LPs around the world to fund these investments. So there are a lot of changes. I think, this was reported by Bloomberg. We recently made an acquisition of Global Atlantic, which is a great company. And, we're also looking to extend our liabilities and partner with best-in-class managements, not only in our funds, but also at KKR. And I think with this transaction, that's what we've done.